Ladies and gentlemen, in a world undergoing unprecedented changes, economic, geopolitical, and technological, there is one looming threat that markets continue to underestimate: the mounting risks from the escalating trade tensions between the United States and China. Today, I am not merely discussing tariffs or trade policies. I want to take you deep into a conflict that is simmering beneath the surface, a tariff tango that Wall Street is dangerously downplaying. Why call it a tariff tango? Because the series of tariffs, retaliations, negotiations, and diplomatic breakdowns between the world's two largest economies resemble a tense and unpredictable dance, each step laden with risk to global supply chains, manufacturing flows, and financial market stability. Dewardric McNeal, a seasoned expert who once served at the U.S. Department of Defense and now executive managing director at Longview Global, has warned that financial markets are suffering from excessive optimism in the face of a dangerous reality. He argues that Wall Street is clinging to the hope of short-term diplomatic resolutions, while in truth, both nations are preparing for a strategic economic decoupling, an excruciating, complex, and long-term process. We often perceive tariffs as economic tools, meant to protect domestic industries or apply leverage in negotiations. But today, tariffs have become weaponized, serving political ends. The U.S. government has invoked the International Emergency Economic Powers Act, IEPA, to impose trade restrictions without congressional approval, an unprecedented move in modern times. More alarming is that the implementing agencies, such as U.S. Customs and Border Protection, are under-resourced and understaffed to manage this wave of disrupted goods. Congestion, delays, and lack of transparency are plaguing ports and airports, critical arteries of global trade. McNeal underscores a critical truth: no major policy can succeed without a capable enforcement mechanism. And when the machinery of implementation falters, investor confidence is the first casualty. Wall Street thrives on expectations, but expectations are not reality. Stock indexes continue to rise. Earnings reports remain optimistic. It appears on the surface that the global economy is sailing smoothly, but McNeal sees the opposite: a lack of strategic direction, a diplomatic deadlock, and a brewing collapse in global supply chains. Think about sectors like high-tech, semiconductors, battery manufacturing, and pharmaceuticals, industries deeply dependent on Chinese components or allied nation imports. When tariffs choke these supply lines, prices soar, competitiveness declines, and ultimately consumers bear the cost. Yet investors continue to hope this is just temporary, or both sides will find a balance. McNeal calls this a dangerous naivety, because this time, the conflict is no longer about trade imbalances. It is about strategy, national security, and technological dominance. For over 3 decades, the world has benefited from miraculous growth fueled by globalization, with U.S. China trade at its core. That era is ending. The U.S. no longer sees China as a promising market, but as a strategic rival. And China is no longer relying on Western technology, but investing heavily in indigenous innovation. This separation will not be peaceful. It is marred by distrust, sanctions, and painful restructuring. Multinational companies now face a hard choice: maintain Chinese partnerships and risk violating U.S. sanctions, or comply with government mandates and lose access to a massive market. McNeal warns that policy uncertainty is the greatest threat to long-term investment. When investors don't know what the rules will be in 6 months, they hesitate to expand, hire, or innovate. Looking beyond the U.S. and China, we see a global trend of economic fragmentation. New trade alliances are emerging. Nations are rebuilding domestic industrial policies. The term globalization is being replaced by localization, self-reliance, and supply chain security. This is not a phase. It is a long-term shift. And if Wall Street continues to value assets using 20th century logic, based on boundless globalization, it will be left behind by a new geopolitical reality. McNeal calls this a mandatory awakening. Once investors realize that the world has changed, their capital allocation strategies must follow suit. It's not just about returns anymore, it's about resilience. No one can predict the future with certainty, but McNeal suggests 3 principles for investors to hold on to. Don't underestimate politics. Trade policies, tariffs, and investment restrictions are now deeply geopolitical. Ignoring them is ignoring half the picture. Shift focus from growth to resilience. In turbulent times, companies with flexible supply chains, diverse consumer bases, and strong domestic capabilities will weather storms better. Always have a plan B. Whether you're a personal investor or a corporate executive, geopolitical risk requires fallback strategies. Ladies and gentlemen, we are living through a historical turning point in global commerce. The policy decisions made today, from Washington to Beijing, will shape not only the flow of goods, but also capital, technology, and trust. Dewardric McNeal is not sounding the alarm to cause panic. He is urging awareness, an awakening from the illusion that economics and politics are separable, an awakening that geopolitical risk is no longer an abstract concept, it's now embedded in your portfolio. If we are willing to face that reality, adapt to it, and act on it, then even in chaos, there will be opportunity. But if we continue to indulge in false optimism, believing in market rallies without acknowledging geopolitical roots, then the awakening will come, and it may come painfully. Thank you for listening.